Look out below. Today, we're going to talk about my outlook on the S&P 500, why I think the S&P 500 may in fact have a near-term pullback despite its more positive midterm outlook. Then we're going to look at the charts for the US dollar. And the US dollar, in my opinion, has a pretty good potential of a near-term bounce. Now that sounds maybe a bit controversial, but I'm going to give you guys some evidence to that. And then finally, I'm going to talk about if the US dollar does in fact bounce, what impact that's going to have on some securities that you may hold. So stick around and we'll talk about what you need to know and why you need to know it in this market for the coming month or so. My name is Keith Richards. I'm technical analyst, President and Chief Portfolio Manager at Value Trend Wealth Management, and this is the Smart Money Dumb Money Show. And remember, you're smart money because you watch this show. Let's get started. All right, well, let's get started with the S&P 500, and I'm going to give you the big picture first. And what you can see here is that the S&P 500 has been making a new high. And as you guys know, new highs on a market represent a positive breakout from a technical point of view. You've got support from a nice crossover on the MACD histogram. I talked about that on my last video. You've got a rising MFI, which is the money flow index. It's the momentum of positive money flowing into the S&P 500. So this rally's been supported by volume. And you've also got a rising RSI, which is pure price momentum. I might point out that we're also seeing positive breadth on the market, meaning that the market participation has been fairly widespread. So it is a fairly healthy looking market on the intermediate term. But I see some signs of a potential pullback in the near term, and I'll discuss that now. Now let's take a look at what I call my short-term trading system. I've been using this system for years. And what it tends to do is give us some pretty accurate predictions actually on near-term moves on pretty much any market you can look at. Now the key words here being near-term, because this is not an outlook that carries much past usually a week, 2 weeks, 3 weeks. Sometimes it does, but typically this is just a short-term look at the market. So let's see what we're seeing on this indicator. Now, what I'm using is something called Bollinger Bands, and I've discussed that on my videos, the Technical Analysis Basics videos. If you watch that series of videos, you'll learn about indicators like the Bollinger Bands. But basically, the Bollinger Band is a volatility band. It tells us whether the market is moving within 2 standard deviations outside of its normal range of movement, whether it's at 2 standard deviations over its range of movement or under its range of movement. Well, right now we have been running along that top Bollinger Band, meaning that it is moving at a fairly quick pace and beyond its more normalized range of movement on the charts. We can also take a look at something called stochastics. Stochastics, again, discussed in my Technical Analysis Basics series. That's an indicator that tells us very short-term moves. Typically, it's going to hook up or down from overbought or oversold levels. You can see back here, for example, we were running along the lower Bollinger Band. We also had a hookup from an oversold stochastics, and this indicator is called RSI. It's more of a midterm look, and you can see it got quite oversold, and those three lined up to produce a rally on the S&P 500. Well, we're kind of getting the opposite right now, aren't we? We're seeing a move at the upper band of the Bollinger. We're seeing a hook down possibly on the stochastics, most certainly at least leveling off. And we definitely see an overbought signal on RSI. Now, this is all short-term stuff, guys, because it's a daily chart and we're applying these indicators to that daily chart. So what that typically means when we see this kind of stuff are movements like this, where we got an overbought stochastics, a near overbought RSI. You get little moves on occasion that often will either move into a larger move or just do a little blip and then return to all things being normal. So we can't predict how deep a correction will be, but given that we're getting all three signals right now, I'm suggesting there's a good potential for the market to pull back in the next coming couple of weeks or so. And here's some more evidence to that thought. I'm now going to show you another indicator that suggests that markets may be in for at least a near-term pullback, and that's the put-to-call ratio. Now again, I encourage you to go back to my technical analysis basics videos, and I talked about the put-to-call ratio. In essence, puts are options that are bought by people that are bearish, traders that are either hedging against losses or making an outright bearish bet. Calls are bought by investors who are bullish. They're either hoping to buy in on a stock at a future date at a good price that they try to lock in now, or they're just speculating using the options by themselves, but they do think that the calls are going to go up because the stock's going to go up. Now we can apply this to the stock market by looking at all volume of puts and calls, and you can see that typically when markets are very, very complacent, meaning not many puts are being traded versus the number of calls, it tends to lead into market corrections. This is 2021, and you guys know what happened in 2022. I'll zoom in a little bit. Same thing when fear is extremely high, such as in 22, after the market fell, people get more inclined to buy puts versus calls. That ratio goes up, and it can signal abundant amounts of fear, which is opportunistic, just as easily as it can signal abundant amounts of complacency. Well, where are we right now? Through most of 25, markets have been pretty complacent. As you can see, not many put buying. And right now, the ratio of put to call is 0.79 puts per call. And typically when we get around 0.75 or lower, that can indicate a sell signal. We're really close to that signal, and in fact, as you see on the chart, we've been punching below 0.75 a few times over the past few months. So this is telling me that there's a decent chance of a pullback in the coming weeks. The next thing I want to look at is another sentiment indicator. It's a compilation of what we call smart money and dumb money. Now, smart money is generally large institutional traders. They're managers that have to hedge out large positions. They're managers that take large positions in and out of the market. They're usually more informed than retail money, which is what we call dumb money. Dumb money doesn't mean that every retail investor is dumb. What it means is, in aggregate, most retail investors are wrong at extremes. So to give you an example, retail investors will sell near the bottom in panic and typically buy near the top in irrational exuberance. So we're looking for when moments of smart money and dumb money are doing the opposite thing. You can see that on this chart here, where we see that smart money, which is the blue line, was buying as the market reached a market bottom. In fact, it peaked out. Smart money buying peaked out at the market bottom back in April. At the same time, dumb money was selling at the market bottom in April during the Trump tariff announcements. Now, the opposite has happened recently, where we have dumb money, which is the red line, is net buying. The line is moving up. Their confidence is increasing. They are buying more and more stocks. Meanwhile, the blue line, which is dumb money, or I should say smart money, the blue line is moving down, meaning that smart money is becoming less and less confident about the stock market. This often leads into a market correction. Now, they're not at extremes yet. Remember, in April, we saw an extreme here for smart money picking stocks up and dumb money selling. Neither one of these lines are at extreme at this point. If we zoom in, you can see that dumb money is getting over that irrationally exuberant line, but smart money isn't bailing out too aggressively just yet. Still, the lines are moving the wrong way, and we should be aware of this and be prepared to act on some sort of a potential correction in the near term. Final reason why I think the S&P 500 and probably the TSX at the same time will have an interim short-term correction, and that's seasonality. So let's take a look at this chart, and it's two charts showing us the same thing. This is the month of July. So this chart on your left is the month of July, and you can see for the first half of the month, here's the 15th, the first half of the month, typically most days are positive on the S&P 500 over the past 30 years. This is the 30-year study of seasonality in July. So the first half of July is typically very good. And we've been in a pretty good period of market returns so far in July as I record this on July 7th. Well, probably that'll last for another week at least. I'm not sure when you're going to see this video, but the statistics show us it's the second half of July that those non-stop positive days tend to slow off. So let's now take a look at the bigger picture for seasonality, and that's this chart here. And you can see that typically over July, the market is up, and then as the sentiment trader chart showed us, starts to falter closer to the end of the month. But thereafter, you can see August, September, and October can be very, very flat. So there's a reasonably good chance for the S&P 500 from a seasonal perspective to start slowing off in the latter part of July. Again, one more reason to look for a short-term correction near term. The next thing I'm going to discuss is the US dollar and why I feel it's going to have at least a near-term pop. That pop could turn into just a short move and then a return to being a soft US dollar, or it could turn into a more significant move. No predictions here, folks. What I am noticing is that there is strong indications from a technical perspective that the US dollar should begin to rally in the near term. So here's why. This is the weekly chart of the US dollar going back to late 2022. And you can see it had been in sort of a trading range, and then it broke down right after Trump began announcing his tariffs earlier this year. Now, that's helped currencies through the world increase their value versus US dollar, but it's not really helped those of us who own US currency stocks, as many of us will attest to that. But what I'm looking at here from a pure technical perspective is that the MACD, while it's moved down, as you can see, is beginning to hook up. And you can take a closer look here and you'll see that the histogram often tells the tale before you see a hook on the MACD lines. And you can see they've been moving up. That means that the momentum to the downside on the US dollar is definitely turning the corner. It's not moving down with the same velocity. Take a look at RSI, which is our next line. And you can see RSI has been running along the deeply oversold line. That doesn't tend to last. As you can see, often when RSI gets too low, the market will bounce. And this happens over and over again through history. So what I'm trying to show you here is already we have two indicators suggesting that the US dollar is at least temporarily oversold and due for a bounce. Finally, stochastics, which is a very fast-moving indicator, has been oversold for some time. Again, that can last a while, but almost any time it happens, you get some sort of a move on the dollar or other securities as well. So stochastics has been oversold literally since March of this year. And again, that doesn't last forever, especially when you get a lineup on these other two indicators suggesting that the US dollar will likely have a pop. And my technical perspective suggests that we'll probably see a rally of about 3 or 4% on the US dollar back to 100 on the World Currency Index. Another piece of evidence suggesting a rally on the S&P 500 is sentiment. Now again, I wrote the book, Smart Money, Dumb Money, on all of this stuff, and I do encourage you to read the book because I cover tools like this that can offer additional clues beyond the charts and beyond the fundamentals. What sentiment tracks is investment behavior and attitude, and we're looking for extremes. So you can see the US dollar sentiment is extreme right now. Now let's just look a little bit of history here. You can see that when sentiment towards the US dollar back in 2017 was extremely bullish, the US dollar made a peak. Back in 2018, when sentiment was very bearish towards the US dollar, it made a trough. On and on. Now sometimes, like during 2019, sentiment was very bullish and the US dollar kept climbing. So it's not always a signal that the market will turn down, but more often than not, like here, when sentiment was extremely low in 2021 towards the US dollar, that was a very nice bottom. And then at the top of the cycle, sentiment got very, very bullish on the US dollar. And of course, that represented a moment where the US dollar would fall. Over and over, I don't need to cover them all, but what I do want to zoom in on here is that the US dollar is experiencing a period of extreme bearishness. Sentiment is bearish towards the US dollar. And what that usually means is the US dollar is going to move up again. History repeats. So let's assume that the US dollar has some sort of a rally. Again, my suggestion is 3 or 4% upside, which is a decent enough rally. Who will that affect most? Well, the two areas that it's going to affect most are gold and the emerging markets. Gold, on the right-hand side of this chart, we're going to look at gold first, has had a tremendous rally on the back of a declining US dollar. You guys know that. It's gone up ballistically. It's beginning to consolidate, as we can see on the chart right now. That's because the US dollar is oversold, and I'm not the only one that feels it's possibly going to have some sort of a rally. So gold is taking a rest. Now, if the US dollar does rally 3 or 4%, you may just see gold move down to this trend line, this rough trend line that I've marked on the chart. So we may see some downside on gold if the US dollar rallies. Now let's take a look at the emerging markets chart. Now, the emerging markets recently, as some of you guys know, broke out. I probably have mentioned it a few times on my videos. I know I've mentioned it on my blog before, which is the reason why you should subscribe to my blog at valuetrend.ca. I talk about opportunities like this. A weak US dollar affords the emerging markets to manufacture our toys and trinkets, like over in China and whatnot, at a lower cost because materials are costing them less. Most materials are traded in US dollars. So if the US dollar does rally 3 or 4%, as the charts are suggesting, then you'll probably see some weakness on the emerging markets, at least in the near term as well. So to finish up, my thoughts are that the S&P 500, as discussed at the beginning of this video, is a little bit overbought and very overdue for some sort of a pullback. I also discussed the US dollar, which, opposite to the US stock markets, I think that the US dollar is probably going to have a near-term move to the upside, perhaps 3 or 4%. If that happens, I think that'll push gold down and emerging markets down, at least in the very near term. Probably all of those opportunities are moments to buy gold and buy emerging markets if, as, and when that happens. So I hope that helps. And again, I want to emphasize that you guys should subscribe to these videos because I'm bringing new ideas to you every single week. Don't forget, push like and subscribe, and also go to my blogs and subscribe there at valuetrend.ca, because then you'll be getting the full inside scoop on all of my trading ideas. See you next week.